If you are tithing, if you are making donations, if you are giving to your church or any qualified charitable organization, that should be done after 70 and a half out of your IRA if possible.
Peter, hello. So good to see you. Welcome back to everyone. Today we're getting back to basics. We have RMDs 101, the rules that catch retirees off guard. Required minimum distributions aren't just about taking money out. They come with specific IRS rules that affect how, when, and where those dollars can be used. Understanding these basics can help us avoid penalties, manage taxes, and even support our favorite charity. So, number one, each account is separate. Peter, the IRS requires you to calculate and take the RMD from each of your pre-tax retirement accounts individually. How does this rule catch people off guard?
Yeah, well, everybody's favorite, right? When the government tells us we have to do something that we don't really want to or need to do ourselves. So required minimum distributions is about the time when the government says, hey, you haven't paid tax on this advantaged retirement account yet, and we expect to begin collecting. So if you are turning 73 this year, or you are already 73 or above, this conversation is for you. Now, a lot of people already satisfy the required minimum distribution because they are doing what they intended to do, which is living off of their retirement accounts. Like we saved that money when we're working, now we're retired and we're drawing from them. So where the RMD really applies is when people have excess in their tax-deferred retirement accounts that they don't need for living expenses or don't need as much of as the government requires for their minimum payments. So again, if you're 73 this year, turning 73 or above, this is going to apply to you. Now, what catches people off guard is like, well, where do I have to take it from? If you have IRAs, traditional IRAs, SEP IRAs, simple IRAs, anything IRA related, those can be aggregated. So you could have 10 different IRAs, and if you chose to, you do have to account for every single dollar,
Right.
but you could only take it out of one account. However, 401ks can never be aggregated. 457s can never be aggregated, and 403bs can be aggregated in and of themselves. So if you had 3 or 4 403bs, you could aggregate that. If you have 3 or 4 different 401ks, you have to take it from each one. And Erin, important note, rule change on this is that the RMD is always considered the first money out of an account this year and moving forward. So if you were planning on doing a 401k and rolling it over to an IRA, you have to take the RMD first before you do the rollover, or you could find yourself kind of in a situation where the IRS is confused and wanting to tax you twice on those dollars. But essentially, the first money out, to avoid complication and confusion, always make sure that you are accounting for your RMD. And yeah, it can muddy the water when you're talking about you've got multiple different types of tax deferred accounts with different titles. If they're all IRAs, you should consolidate them. In fact, at a certain point in time, it makes life a lot easier, especially with RMDs, to consolidate all tax deferred accounts.
Okay. Next. You and I have talked about this, but just touched on it before. You cannot use your RMDs to directly contribute to a Roth IRA because Roths can only be funded with earned income.
Right. Yeah. And well, those sort of here, and I'm nuanced, splitting hairs here, but RMDs can never be directly converted to Roth. And that one catches a lot of people off guard. You are also correct, Erin, that those dollars for most people cannot then be turned around and made as a contribution to a Roth because a contribution requires earned income. However, if somebody is 73, 74 and still working, then potentially they can still make Roth contributions. But that is only if you've got earned income. The RMD itself can never be converted. However, there is still a way that if it makes sense, you could theoretically use the RMD, pay the tax on it, take the RMD as taxable income as is required, and then take the net amount and convert over other dollars from your IRA. So it's a little bit of an end around here strategy, and you want to crunch the numbers on this to make sure that you're making a smart decision on that and not encountering higher Social Security tax or losing that extra deduction or potentially causing your healthcare premiums to cost you more. But there are ways almost at any point in time to get dollars into Roth if it's a good move and if that's desired for you.
Okay. Number 3, kind of counter to that one, using an RMD for other expenses is okay. Once an RMD is taken, the cash is yours to use however you wish. Does that include, though, reinvesting in a taxable account?
Sure. Yeah. All the IRS cares about is that you take the minimum amount that they require. You have to take that out of the account. You have to pay tax on it. Now it's yours to do with what you want. You can spend it. You can invest it back in just a non-retirement brokerage account. You can voluntarily send the IRS more money if you like, who knows? That's part of the Roth conversion strategy. Or you could give it away to charity. So spend it, invest it, give it away, any of those. The money is yours. It's out of that retirement account. There's no longer qualifications or tax advantages on it. And if you would like to reinvest it, that is absolutely something, because if we're dealing with required minimum distributions, again, this is for money that people didn't necessarily need for living expenses. For a lot of our clients at Richon Planning that fall into that category, we automate a reinvestment process and begin to reinvest those RMD dollars. We can either do that one time or dollar cost average them in so that they can continue to grow for future purposes. Likely at this point in time, that's like a legacy or estate value, and do so in yet another tax advantaged way to try to leave the most clean, low tax liability legacy to our loved ones.
All right, next, and you just touched on this, you can use those RMDs for charitable donations. How does this work?
This is a great strategy. And by the way, RMDs start at 73, as we already talked about, but this strategy can actually start at 70 and a half. If you are tithing, if you are making donations, if you are giving to your church or any qualified charitable organization, that should be done after 70 and a half out of your IRA if possible, because these are dollars like you see on the screen that skip the IRS, right? They skip you, in fact. So the IRS does not tax you on this. It goes right from your IRA, which you've never paid tax on, directly to your church or charity or organization. The check is generally cut to you. It's called a QCD, a qualified charitable distribution. Check is cut and sent to you, but made out in the name of the charity that you indicate. And then you turn around and give that to the charity. And then to further complicate this one and give it a little wrinkle, there's actually no official form that you have to file with your taxes to indicate that you've done this. So like take a photocopy of that check and just make sure that your accountant or CPA or whoever's helping you with your taxes does denote and understand that you made this donation directly out of your IRA. And after 70 and a half, you can do up to $100,000 per year as a tax-free gift to a charity if you've got it like that.
Yeah, it is such an important and powerful strategy. I mean, especially when we are charitably inclined, if you are putting money in the collection plate, just know there's a more tax efficient way to do it.
Yeah, because look, if you do that out of your cash, that means you've already paid tax on those dollars. Keep those dollars that you've already paid tax on, take the ones out of your IRA that you've never paid tax on, give them to your charity. They won't pay tax on them either. And then once you are 73, it also checks the box and satisfies these required minimum distributions. It's a win-win-win.
Win-win-win. All right, last, and this is kind of our umbrella theme here, RMDs are taxable.
Yes. In fact, that is the point of the RMDs, is that those dollars have built up in an account that you made an agreement with the IRS that you would not pay taxes when you earned them, and they were okay with that. And then the account grew and built, and they were okay with you not paying taxes along the way, all the way up until the age of RMDs, 73 this year, and anybody turning 73 or above, right? They are a debt collection agency, and at a certain point in time, they want to collect the dollars that you owe them. And that's what these required minimum distributions are really all about, is that you have to take out a certain amount of money and it is included in your taxable income and taxed like it's brand new earned income that you just made. So whatever your tax rates and brackets are, those are going to be impacted by these RMDs, and they're going to go into that equation for how much you ultimately pay in tax. That's the point.
I'm really glad we got a chance to break this down. I think that a lot of people are, we're more educated now because the onus is on us to plan our retirements, Peter.
Sure
and
is.
of course, I know part of the calculation with you and your clients is also, how do we get money in that tax-free bucket? Because then we don't have RMDs on those Roth accounts. But yes, we have to be strategic with this. If somebody would like to sit down, break this all down with you, what's the best way to reach you?
Yeah. And there are, a lot of good strategies for trying to control and manage your lifetime and legacy tax liability. Just deferring and defaulting to the IRS plan for paying taxes is probably not the one that's in your best favor.
Right.
So give us a call. We walk people through this all the time, talk about the strategies to control those RMDs, which also, by the way, can control taxes on your Social Security and how much you pay for Medicare. So there's a lot of ancillary benefits here for really doing some proactive tax planning in part of the bigger picture. Give me a call, 919-300-5886, 919-300-5886. You can also go online, RichonPlanning.com, and you can schedule a phone call or a virtual or in-person appointment there. And I do have the online retirement tax bill calculator, which sort of shows a side-by-side analysis of what your RMD tax bill is likely to be versus what you could potentially be proactive and bring that down closer to. And looking at those side by side is eye-opening. A lot of people can tell me how much is in their retirement account. Very few people can tell me how much they're likely to pay in taxes over their lifetime on that retirement account. So take a look at that. And that is at 919retired.com. 919retired.com is the online retirement tax bill calculator. Go there and take a look. It's worth seeing those numbers.
Absolutely. Peter, thank you.
Thank you, Erin. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. One of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.